Hey everyone, welcome back to Corporate Decoder. Today, A&Q Multi-Strategy Fund just filed a post-effective amendment number 2 to their registration statement, and I am seeing some interesting details about how they manage money. Quick note, this is not financial advice, just my take on public filings for educational purposes. This fund is basically a fund of funds, meaning it invests in other investment funds and managers, which comes with its own set of risks and costs. So what is the A&Q Multi-Strategy Fund all about? Well, it is a registered closed-end management investment company. That means it is not like a typical mutual fund where you can buy and sell shares every day. It is more specialized, and investing in it involves a high degree of risk, as they'll tell you themselves. Their main goal is to make money by putting their cash into a carefully chosen group of alternative asset managers and the funds they run. Think of it like picking the best chefs to cook your meal, rather than cooking it yourself. They expect to start offering these shares as soon as possible after this registration statement becomes official. Now, let's talk about the money side of things, because this is where it gets really interesting for investors. They've laid out the expected expenses. If you invest a hypothetical $1,000 and don't pay any sales load, you are looking at paying $267 in expenses over the first year. Over 5 years, that number jumps to $805, and over 10 years, it is $988. That might not sound like a lot, but remember, this is on just $1,000. This is a key point. Investing in a fund of funds often means paying fees at two levels at the fund itself, and then indirectly paying the fees of the underlying funds it invests in. And if you are thinking about investing, be prepared for a significant initial commitment. Generally, you'll need at least $50,000 to get started, though they can lower that to $25,000 for some investors. This isn't a casual investment. Here is a big one, an incentive fee. The fund manager, UBS Asset Management, gets paid an extra fee. It is 5% of the fund's net profits paid quarterly. This is on top of their regular advisory fee. This type of fee structure can sometimes incentivize managers to take on more risk to chase higher profits. And they are very upfront about that. They even mention a high watermark calculation, which means they only get paid if they beat their previous best performance. But remember, they don't have to pay back any incentive fees if the fund later loses money. In the last fiscal year ending March 2026, the advisor collected a hefty $1.8 million in these incentive fees. This shows that the fund likely performed well during that period, which is good for investors, but it also highlights the potential for significant payouts to the manager. Looking at the other expenses category, they estimate this at about 0.59% of the fund's net assets. This covers various operational costs not tied to specific investment management fees. This is a crucial number for a fund of funds, acquired fund fees and expenses. It is a massive 28.49% of the fund's net assets. This figure represents all the fees and expenses charged by the underlying investment funds that this fund invests in. This includes management fees and, importantly, performance or incentive fees charged by those underlying managers, which can be around 20% of net profits. So investors are paying fees at the fund level, and then indirectly paying another layer of fees to the external managers. When you add it all up, the total annual expenses come out to a staggering 31.16% of the fund's net assets. This is extremely high, even for a fund of funds, and it means a significant portion of your investment return needs to go towards just covering costs. For comparison, many traditional mutual funds have expense ratios well below 1%. A 31% expense ratio means that for every $100 invested, over $31 is eaten up by fees each year before any investment gains or losses are even considered. They even provide an example. If you invest $1,000 and assume a 5% annual return, after considering all the fees, including a sales load, you'd pay about $282 in the first year. Without that sales load, it is still $267. This illustrates the real impact of those high fees on your potential returns. Let's quickly look at the financial highlights. For the year ended March 2026, the net asset value per S-Share started at $960.15. They saw a net gain from investments of about $130 per S-Share. After all the fees, including the incentive fee, the total return for that year was 10.99%. This is a solid return, but it is important to remember how much of that was eaten up by fees before it even got to the investor. Now, about borrowing. The fund does use debt primarily through secured revolving lines of credit. In March 2026, they had about $12.8 million in principal outstanding. Their asset coverage per $1,000 of borrowings was over $24,000. This means they had a lot of assets to cover their debt, which is a good sign for managing that borrowing risk. This filing dedicates a huge amount of space to risk factors. And for good reason. Being a fund of funds means you are subject to all the risks of the underlying funds, plus the risks of the fund manager selecting those funds. They specifically call out that these strategies involve risks not present in direct investment programs. This is because you have layers of fees, layers of management, and less direct control. Leverage is a big topic. Both the fund itself and the underlying funds it invests in can use borrowed money. While leverage can amplify gains, it also significantly amplifies losses. Imagine a seesaw. Leverage makes both ends move much more dramatically. They're very clear that this is a high-risk strategy. Given they invest in alternative asset managers, it is no surprise that foreign investments are a major part of the picture. Investing in other countries, especially emerging markets, comes with a whole host of risks: currency fluctuations, political instability, different regulations, and less market transparency. This is a critical point for any investor liquidity. This fund is a closed-end investment company. You can't just sell your shares back to the fund every day like a mutual fund. They may offer to repurchase shares quarterly, but it is not guaranteed, and it is entirely at the board's discretion. This means your money can be tied up for a long time, and you should only invest if you can afford to lock up your capital. And then there are the conflicts of interest. With UBS involved as the investment advisor and also having relationships with the underlying managers, there are many potential conflicts. They admit that their affiliates might receive fees from these investment managers, and that they have to balance the interests of the fund with their own business interests. This is a common theme in finance, but it is good they're transparent about it. So, what is my take? The A&Q Multi-Strategy Fund offers access to alternative investment managers that most individuals wouldn't be able to invest in directly. However, the incredibly high expense ratio of over 31% is a massive hurdle. That is a huge drag on performance, and it means the fund needs to achieve truly exceptional returns just to break even after costs. The limited liquidity and the multiple layers of fees and risks associated with the fund structure make this a very specialized investment. The risk I am watching is the impact of those sky-high fees on long-term returns. My biggest concern is whether the exceptional returns needed to overcome that 31% expense ratio can be consistently achieved over time, especially given the inherent risks of the underlying strategies. Alright, that is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching, see you next time.